Hey there, I just want to put together a quick video here just to kind of share my thoughts on the market and some similarities that I'm seeing from the current price action versus what we saw back in October 2023 when we were coming out of the most recent market correction. And both have bottomed so far in a very similar fashion, and that is where there's just this V-shaped recovery where there's a very quick sell-off that's then quickly eaten up by the buyers, and there's really no pullback at all. You can see here, very quick dump, kind of a V-shaped recovery, and there's been no pullback at all either. Obviously that's a bit problematic for a trader like myself who is primarily a pullback trader, but it is what it is. If you take a look back at the October correction, which was a correction of about 12%. The most recent correction here is about 16%, so a lot deeper of a correction, but anything beyond 10% is categorized as being a market correction. So both have been in correction territory. You can see that on the 1st of November, we had a follow-through day here, right? So if you look at the top right over here, you could see that price had advanced more than the 1.25 or 1.5% that's required in order to be considered a follow-through day. And it was also on volume that was greater than the day prior. So that was a follow-through day. That was our first purely technical indication that the price action is starting to turn in a more favorable direction for the bulls. And then right after that day, we had another price action signature that highlights the underlying strength, which was price gapped up and then left that gap unfilled. Okay, so gapped up above the short-term moving averages, and it did not come back down to fill a gap. So most gaps are filled, and if they're not, it's telling you that if gapping to the upside, there's a lot of underlying strength, and if gapping to the downside and left unfilled, it's telling you there's a lot of weakness currently on the chart. So you could see over here why I was pointing this gap that's left unfilled out is because we had something very similar here where we had our follow-through day, which is marked, the low of that follow-through day is marked by this red line. And then after a day's pause, we then gapped up today and we left that gap unfilled. Okay, so far it has a very similar feel. The only real difference here, that gap that's left unfilled here was also right below the 50. The gap that's left unfilled here is right at the 50. So almost identical scenarios here, which is why I want to take the time to kind of share this. So here there was no pullbacks at all until several weeks into the initial move higher. So far here, it's the same exact thing playing out. There's been no pullback at all. Okay, so that's what we referred to as being a lockout rally. Lockout rallies are where if you didn't get in during the early onset of the rally attempt, you basically are forced to chase or miss the entire first leg up entirely. Okay, so that's actually ironically what happened to us back in November, and that's what happened to us so far this August. There's really no workaround for that unless you bottom fished. It's just not in my trading style as a pullback trader to buy into weakness. That's just me personally. That's a weakness of my strategy. All strategies have their weaknesses. I accept it. It doesn't bother me. I mean, obviously, it's a little tough to see stocks pushing out without you, but it is what it is. So now, with that being said, if we hop down to the 195 minute and kind of take a look at this through the lens of stage analysis, we could go back to October and kind of look for, visual similarities. The first being that back here in October, there really was no bottoming pattern at all, right? It was just a V-shaped recovery. Here, it's really the exact same thing. You could argue maybe it was a bit of a double bottom here, but it really wasn't, what your textbook double bottom would look like. You really would have wanted price to retrace down to at least the lows area, if not preferably undercut and then reverse before breaking above the neckline. So really, there's two types of ways that the market's going to bottom. It's either going to bottom with a V shape, which is more rare. It tends to be more rare, or it's going to build up some kind of bottoming pattern. In this case, you have a little bit of a double bottom before breaking higher. If we go back here, the market tried to bottom several times, however, failed. And in this instance here, you can see you have a double bottom. And then here you kind of have this double bottom as well, or you can just call it a little flat base. So this is generally what you're going to see play out more often than not, is you can get some kind of bottoming formation. That's what I much prefer versus a V shape, because obviously V shaped will lock me out of participating. So that's just the deck that the market gave us, this most recent bottoming attempt. We've just had a straight move higher. So now what I want to get to is, well, first I'll also highlight that you could see this indicator here. This is just tracking the distance from the moving average. So the distance between the moving average, which I have here, I believe it's let's take a look this so I don't lie to you. I believe it is the 21 SMA. So I'm using the 21 SMA and the 195. The distance from the 21 SMA right now is about 5%. Price is about 5% elevated above that moving average. Why that could be helpful is because it's going to help us measure the current level of overextension from that moving average, which is currently at 5%, and then use that against the average level of extension that price usually gets from that moving average to kind of decipher what we could expect. Is that stock currently extended from the moving average? Because if it is, what would you want to expect? Price to come back, it's what we refer to as mean reversion. Price to revert back down to the mean and then find support the moving average, kind of build a little base and then continue higher. So if we're 5% extended right now, and you can see that we have, the last time we were anything beyond 3.6%, we pulled back. It's very rare to see us at levels of extension that we are right now. Okay, so it doesn't mean we can't continue to go higher. In fact, over here we were about 5% extended. We consolidated for just a couple of days and then roared higher. But it does tell you that at least at this point in time, one could be more cautious when buying to the upside, because the likelihood of a pullback being around the corner is far higher than if we were to be at levels down here where you're only a percent or two above. Okay, so short term, we are currently overextended. Now, we haven't got a pullback yet so far. Okay, so it's very tricky to get involved at this point until we get that pullback. If we go back here, we could see from the bottom, the lows, to the high of the first leg, the market moved up about 15%. So far, from the bottom to where we are right now, we've moved up about 12.5%. So if this is to play out exactly like we did in November, there would be just a little bit of upside left. Even if it doesn't, the likelihood for there to be a lot more upside is fairly low. So what I'm waiting for personally, just so we're all on the same page here, is just for this moving average now to catch up and then to watch how price reacts at that moving average. And what I prefer to see is some kind of consolidation just like this at that moving average. And then where I'll look to get aggressive is when we finally reemerge to the upside, if we reemerge to the upside. So going back real quick and just looking at this previous correction, which interestingly enough occurred right around the same time last year, we saw one leg down, we saw two legs down, we saw three legs down. In most traders' books, most swing traders, they'll consider, including mine, they'll consider a correction to be significant if you see at least at least two legs down. In this case, we saw three legs down. So it was considered to be a very significant correction, and one that could lead to a powerful move once we reemerge to the upside. In this case, back here in April, we were hoping that we were going to get that second leg down. However, we didn't. So we only got one leg down, meaning that the likelihood for a large upside move was greatly diminished. Thankfully, this time around, we've seen one leg down and we've seen two legs down, and this has been a very deep correction, okay, almost 16%. So, hopefully what we see over the course of the next couple of weeks is, let's kind of annotate this the best that I can. we see, the moving average do this, something like this, maybe flatten out like so, and price does something like this. And then we have a very good risk reward trade, right? A high probability trade. So if it were to do something like this, and then it would break out, all we would look to do, if trading the Qs primarily, is go long with a stop loss being right around the 30 moving average area. If you don't want to trade the index itself, what you'd be looking at is just to see where the strength is on your watch list. So I have a lot of names out here on here for us to pick from. At that point in time, throughout the first consolidation, after the first leg up, which I can promise you it's going to happen. I can't promise you that there's going to be another leg higher, but I can tell you that there's eventually going to be some kind of consolidation. We're going to want to be focusing very heavily on the watch list that we've built out the last couple of weeks. So you can find this in the newsletter. It's at the bottom. And just look to see during that point in time what stocks are consolidating in a constructive way, right? So like here you have a little bit of a bull flag. So if you saw a stock bull flagging like this, while the Qs were also forming out that consolidation, you would want to entertain a clean chart like this, right? You have a pretty easy to identify pivot. And at the time the Qs are breaking out, you would want to see this stock break in as well, if not leading the market, meaning it breaks out ahead of the market. Okay, so that's kind of where I stand right now with regards to the market. Do note that we had several unfilled gaps to the downside. Now we're getting several unfilled gaps to the upside. So just as this was a very powerful move to the downside, so far this has been a very powerful move to the upside. I would have been a little more comfortable to say that if there was more volume, because there really is not a whole lot of volume at all right now. But when markets do sell off, they tend to sell off hard. It's a lot easier for investors to panic when the markets are going lower than it is greedy to the upside. So you tend to see a stronger emotional response when the market's selling off. So that's why I kind of discount the lighter volume that we've seen thus far in the rally. So to conclude, right now we pushed up almost 12.5%. We're pushing into a key resistance area. We're short-term overextended, and we're currently in what's referred to as a lockout rally. So I would expect, considering the variables that we just highlighted, that there's a good chance we're going to begin to consolidate at some point in the next week or two. Until we get that consolidation, we just want to remain patient. And at the time, at some point, it's going to build out some pivot, just like we had here, just like we had here. It's going to happen. And then we could look to play the continuation to the upside. We could also consolidate and then break lower. Either way, there's going to be some sort of range that's built out that we could trade in the coming weeks. So we just want to be patient.